All right, we've finished another module. You've finished number 5, which is on financial ratios and shareholder distributions. So there is a summary of the contents of Module 5, and you'll find it in PDF form in my courses. And this is just the first page of it, so you might want to look at it because it has more detailed note-taking on my part, on your behalf, looking at the content of the videos. The content that you have just completed included the final portions of the course from Professors Ham and Brown on the financial ratios and share buybacks, and then the exercise with Professor Oshalov on analyzing the company performance against its peers. Topic 1 for financial ratios had learning objectives of using balance sheet and coverage ratios to evaluate the company's financial health, utilizing income statement ratios and common sizing to assess profitability, and then utilizing different rates of return to probe the financial and investment performance of the company. The terminology was quite dense, many tools and many interpretations of tools. So this, as I mentioned in the intro, is one of the main things that you're going to hopefully take away from this course. So let's make sure that you understand it. So I've categorized them into groups of ratios. The left column represents balance sheet ratios, the middle income statement ratios, then rates of return, and then some other terminology found in this topic. The first set of ratios deals with productivity, and they include asset turnover, PP&E turnover, working capital turnover, accounts receivable turnover, inventory turnover, and accounts payable turnover. A lot of turnovers. Anyway, so those should sound familiar to you. If not, as always, note them so you can review them before you move on, because you want to build solid foundation and then keep building upon that and the layers. The next set of ratios deal with what we call the cash conversion cycle. And this is a relationship between 3 ratios. The first is days sales outstanding, which looks at how fast you collect your receivables. The second is days in inventory, which is how fast you sell your inventory. And the last is days payable outstanding, which is how long it takes for you to pay your bills. And the combination of those lead to one metric called the cash conversion cycle, as measured in days. Hopefully that sounds familiar. Next group is on liquidity. And this answers the basic question of, do I have money to pay my bills? The two we looked at here were the current ratio and the quick ratio. Next category is solvency. And this answers the question of, am I financed properly? Do I have too much debt? Do I have not enough debt? And the ratios in this group include liabilities to equity ratio, the debt to equity ratio, and the total debt to EBITDA. The last in this group is coverage ratio, and these are times interest earned, EBITDA coverage ratio, cash from operations to total debt, and free cash flow to total debt. These 5 categories comprise the ratios that primarily probe the balance sheet. The next set in the middle are the income statement ratios. These are the different margins. As we work down the income statement from revenues coming down, the first stop is gross profit, so gross profit margin. Next stop down is operating profit margin. Third stop down, bottom line, is net profit margin. And then within the expenses, we want to probe some of them more carefully, such as the SG&A, otherwise known as selling, general, and administrative costs, as a percent of sales, to see if we're gaining efficiency as we grow the company. The next is R&D, research and development, as a percent of sales, to show the amount of money we allocate for investing into the future by way of R&D efforts. Then we covered the techniques of vertical financial statement analysis on balance sheet and income statement items, and then horizontal, looking across time. In the next category of ratios of rates of return, we looked at return on assets and then how we disaggregate that into components. The next is return on common equity and the associated disaggregation. Then the return on invested capital and dividend yield. And along the way, we had a little bit of finance terminology as well, such as financial leverage, which shows the degree to which we rely on debt for our financing, the capital structure and leverage, recurring and non-recurring items in the income statement, and then after-tax interest expense, which we use as a component for several of our analyses, and then minority or non-controlling interest in the earnings. So after finishing this topic, you should be able to answer these questions. Is the company able to pay its bills that have become due? That's liquidity. Is the company financed adequately to continue in business for the foreseeable future? That's solvency. Is the company lean and mean, utilizing its assets efficiently? That's productivity. And does the company manage its core business efficiently to manage its cash needs? That's the cash conversion cycle. And then is the company managing its cost in order to generate income? Profitability. Is the company generating strong returns on investment? Rates of return. And how is the company able to deliver their investment returns? Through disaggregation. So these all fit into patterns that hopefully you'll become quite good at and able to interpret for not only one company, but for any company. So I'm going to give you a quick tour through these ratios and walk through the interpretation. You'll find that there's 3 steps to doing ratio analysis. One is finding the right numbers, because you have pages of numbers and it gets dizzying sometimes trying to get the ratio components to do the calculation. So 1 is find the numbers. 2 is calculate the ratio. Make sure you punch those numbers carefully, because a mathematical error would be a shame. And the 3rd, after you do the proper calculation, is interpret, what I call the so what. What did we see and did we learn anything? So in this first set of productivity ratios, there were 6 that we mentioned earlier. And the general theme is we want to be lean and mean, because we want to be efficient in using our assets to minimize our financing needs. So the example I've cited here is the PP&E turnover, and the calculation is sales divided by the average PP&E. We use the average, by the way, because that way we can account for situations where balance sheets change dramatically from the beginning of the year to the end. For a lot of established, mature companies, it doesn't change much, so this refinement may or may not be as relevant or as illuminating as a company that's a growth company. But good practice has us use this definition using the average items from the balance sheet. Another way to think about this is to answer the question, for every dollar of the investment in property, plant, and equipment, how much did the company generate in sales? And the next is just directionally. So if we see a rising ratio from time 1 to time 2, let's say, then that's getting better, because we want more and more sales generated per dollar of assets. And how can we improve it if we see a trend going the wrong direction? We can divest some less productive assets because they're weighing us down. We can invest in new property, plant, equipment if it has a large impact on growing sales and profits in a healthy way. And then we can outsource manufacturing and shed the PP&E assets, which would also lower the asset base and therefore be more efficient. Or we can maximize capacity utilization, where we have the same investment, but we crank out more sales in that investment. The progression of a factory that is barely enough volume for one shift to then maximizing the capacity of one shift will show more sales with the same factory. And then as we go to a second shift and a third shift in that same factory, we're leveraging even more of the assets to create now triple the amount of daily sales capacity. So that's just an example of PP&E, how it's a fixed cost resource, and we can then use that effectively to grow more and more sales until we need another factory or an expansion of the current factory. So this is group 1 on productivity ratios. Group 2 is that cash conversion cycle mentioned earlier. And the general theme, you might think of this as you need blood in your system to keep things going. And blood in the system is cash, right? So this is how many days does it take us to sell, collect, and pay our vendors? And the example we'll just do, one of the 3 components, is the day sales outstanding, which answers the question of how many days does it take to collect receivables from our customers. The calculation or the formula is average accounts receivable divided by sales divided by 365. You can think of the denominator as daily sales. So if you divide the accounts receivable balance by the daily sales, it tells you how many day sales are in your receivables. So that's how it works. So this one, the faster the better. If we see a low number in very few day sales lingering in receivables as uncollected, that's good. So lower the better. What if we see a bad trend or we don't like the number? We can improve it by tightening our credit policies. Perhaps we're selling to weak customers that either slow or no paying in their behavior. Or we could be more aggressive in our collection process, where we remind people to pay us, and when it's past due, we remind them even more forcefully that it's past due and they should pay us. Or we could change our credit terms to provide economic incentive for them to pay on time. Things such as a late fee if they don't pay on time, or even a discount if they pay early. One of the common techniques is called 2-10 net 30, which means you can take a 2% discount on your bill if you pay us within 10 days of receipt of the invoice. We're giving those customers an incentive if they have cash around to pay us faster, and they can take a 2% discount, which is quite a substantial discount given the difference in the number of days that they are saving. Right? There are many techniques that are used in what we call working capital management, and that's what we're doing here. In this example, we're looking at managing accounts receivable. The third group is liquidity, and the general theme is, can we pay our bills? Very simply. And do we have enough money in cash or nearly cash assets to pay our upcoming bills? The specific formula for one example of the current ratio is current assets divided by current liabilities. You'll recall that current liabilities is what you owe for the coming year. You'll recall that current assets is how much cash do you have plus the other assets that will become cash within 1 year. That's the definition of a current asset. So now the numerator is how much cash you have in a year. The denominator is how many bills you have to pay in a year. The higher that ratio, the better. And that is answering the question. And we like this number at least 1. 1 means that they're equal, namely that you have assets sufficient exactly to pay your bills. Now, in the past, we like to be more comfortable than that tight. And so we've had kind of a rule of thumb of 2.0. But in my experience, many companies, including some of the companies I've worked with, manage much more tightly than having to have 2 times in current assets. 2.0 is absolutely safe. But if it's lower than 2.0, it's more of a question than an indictment. All right, and how can we improve this? We can improve it by having a stronger capital position. In other words, having more capital from long-term debt or equity allows us to have more of that in our current assets, specifically cash or marketable securities. The fourth group is solvency. The general theme is, did we borrow too much? So we're looking at, are we putting our company at risk because we have too much debt or we are too burdened by high leverage? The example among the 3 chosen here is debt to equity. The calculation is short-term and long-term debt combined divided by equity. The question this would answer is that for every dollar of equity, how much debt does the company have? And as a proportion of debt goes higher, then we're taking on more risk, right? So the higher the numerator gets, the more debt we have. Therefore, the more debt we have, the more risk we have of non-payment. In an event of a non-payment, otherwise known as a default, we then shift some of the power of running the company to our lenders, which is not something we want. And frankly, lenders don't want either. They just want to get paid. So this is an important aspect to look at the capital structure for the company. Here, this is a tougher one to say, is high good or low good? And this is one of those, it depends, because if debt is very low, then there may be opportunities to borrow some money, and we would actually increase our return on equity because we're using other people's money to earn profits for our money. But if you have too much debt, then as mentioned earlier, then we may be at risk of not paying our banker on time, and that would then trigger some remedies and default conditions that ultimately could lead to a default and even bankruptcy filings, right? No one wants to get close to the bankruptcy word, right? So that's what solvency helps us evaluate. Group 5 is coverage, and there are 4 examples, but the general theme is, do we have enough to pay our loans? And do we have money, cash and nearly cash to pay our upcoming bills? So similar, but here we're looking at relationships between balance sheet and income statement. So it's a slightly different angle on evaluating our position. The example we'll use here is times interest earned, and the formula is earnings before interest and taxes, and that's divided by interest expense gross. In other words, not net interest expense, but only the expense we paid to our lenders. The question answered is, how many times does our earnings cover interest expense? And note that TIE of 1 means that the earnings exactly equals our interest expense, which is bad news, right? Because we want to have a lot of headway, because if the consequences are dire for us not paying our lenders, then we want some safety margin. So we want this number to clear 1 by a safe margin, not just 1.1, more like 5 to 1 or 10 to 1. The higher the better, because that gives us the more cushion that our profits could drop and we're still able to make payments to our banker. The ratio of it's trending in the wrong direction can be improved simply by looking at the formula. If the numerator goes up, that means your profits are higher. That's good. The other is if our denominator goes down, namely lowering our interest expenses, then that's good. Or of course, if we do a combination of increasing profitability and reducing our interest expense. TIE is one of the most important ratios to look at our ability, based on our current profitability, to pay our interest bills. Group 6 is the set of income statement ratios, and as you see, there are many of them. But the general theme of this grouping is, are we earning any money? And are we managing our revenues and expenses well enough to generate profits? The example chosen is net profit margin, and that simply is net income divided by sales. The question that's answered is, for every dollar of sales, how much profit did we earn? Notice there's a pattern to these questions I'm posing. You take a dollar of the denominator and you say, how much do we get in the numerator? So that's back to this one. It would be, for every dollar of sales, how much net income did we generate? And so if that ratio is above 1.0, then again, the numerator is higher. And here again, we want as high a ratio as possible. It's probably not possible to have 100% of sales be the profit. It'll probably be a smaller percent. So the higher is better, and the differences in ratios vary widely from industry to industry. For example, a software company that's well established could have very high profit margins, especially compared to a business that has low margins, such as the supermarket. So this can be improved by selling higher profit margin products and or lowering our operating costs. Group 7 are rates of return. And as you can see, we have 6 that are a combination of basic ratios and disaggregations. General themes are we earning enough money? So here we're looking at evaluation, not are we profitable or not, but is it profitable enough? So that's the refinement, that word. Do our earnings meet the expectations of our investors for their investment? An example here is return on common equity, and the formula is net income minus preferred dividends divided by average shareholders' equity. You might scratch your head like, what is this preferred dividend? We don't hear about that very often. Preferred stock is a second class of stock where we have different rights and privileges for those investors, and it usually includes an obligation or a promise anyway that the company will pay the shareholders that hold preferred stock a dividend. The amount of the return available to common shareholders must take into account that before we count it as our money as common shareholders, we must first take care of the preferred stockholders. That's why it's net income minus the preferred dividends divided by the average shareholders' equity. Sometimes people call the numerator the net income available to common shareholders, right? But I find the formula just as easy to look at. The question answered is, how much profit is earned for every dollar of common equity? And this one, of course, the higher the better, right? The more profit, the better. And we can increase the return on common equity by increasing net income, right, in the numerator, reducing preferred dividend by maybe repurchasing them and retiring them, or by reducing common equity by doing share repurchases or by paying dividends. We could change our capital structure such that our rate of return rises. That is a set of discussions that happens in the CFO's offices on what is the proper structure of debt versus equity for our company. So there are limitations on ratio analysis because we could do these. They're fairly easy to do. One is GAAP. We rely on financial statements, but there are pros and cons to GAAP. For example, R&D is an expense based on the rule that we expense R&D as we spend the money. But why do we do R&D in the first place? We do it because we're investing in future innovations. It's really an investment. Now, if we had something that lasts into the future, like a truck, then we would put it on the balance sheet and not expense it immediately. But the rules for GAAP are that we would expense R&D as we spend it. So that's a very conservative treatment, in a way assuming that there's no future value of R&D, which obviously cannot be true. we have an intention that R&D is productive in the future. That is a limitation as we interpret the R&D, is that spending a lot of R&D isn't foolhardy, increasing expense and lowering profit. It might pay off in the future with new patents or new inventions. The second limitation is there are fundamental changes in the company. If we look at a major acquisition in year 2, then the ratios when we compare years 1 to 2 are no longer comparable because an acquisition distorts the results in year 2. Watch out for any major changes that you need to take into account as you're evaluating changes from year 1 to year 2 or a series of years. The third limitation is one-time items may distort ratios. And for example, if we sold some land that was highly appreciated and then it generated an enormous profit in year 2, net income and earnings per share for that year would look dramatically higher than year 1. But it's all kind of a flash in the pan because you're not going to sell land every year. This is where we could have a distorted net income and earnings per share based on a non-recurring transaction. There's a term that we call quality of earnings. Quality of earnings excludes looking at these things that are non-recurring. The next is to consider the life cycle of the company itself. If you have a startup, you'll have very different looking financial statements and ratios than if you were a mature company, and those would bear pretty dramatic differences all throughout our ratio analysis. So know the context of the company in terms of its own life cycle. Next is realize that financial statements are backward looking and not forward looking. We're evaluating what just occurred in the recent year or the recent quarter, but what we're usually interested in analysis is what's going to happen next year. We are betting a bit if we rely on historical data that history will have a trend that continues in the future. Now that's true for some companies or some items for a company, but it's not always true. Be wary of things that are changing, that are in the company, its industry, or its competitive position that would alter that the trend in the past may not be the same as we look into the future. And finally, peer companies are hard to find. If we want to compare our company to another, well, there's hard to find an exactly the same company. The ratios that come might be not based on our superior or inferior performance. It might be because the company chose to compare with is not exactly like us. When we look at a company like Amazon, it's pretty hard to find another company that has a business like Amazon. So if we're trying to compare it to another company, what would you pick? A real retail company? Well, Amazon has a lot more than just retail. They now do web hosting. Or people that do video content because Prime has movies. Well, a lot of other companies make movies too. Or comparing them to internet hosting and database services. Well, Amazon has that, but they also sell a lot of items through Amazon.com. A company with many different lines of business, as Amazon does, makes it difficult to find another company that we can use as a benchmark to compare to a company like Amazon. And so these are often challenges. We usually do the best we can, realizing it's not perfect, right? It's the best we can. Suggestions for financial analysis are first to focus on the trends of the company, using the comparison to competitors in the industry, and look at what is happening. An example is if your company is growing at 25% per year, you might think it's time to pop the champagne and celebrate. But what if the industry is growing at 30% and your largest competitor is growing at 50%? All of a sudden 25% doesn't look too good because you're not even keeping up with industry growth and your market share is eroding because your major competitor is increasing market share. The second thing is put your analysis in context, in the context of the industry, the economy, such as the recent years with COVID and other shocks that our system is undertaking, and the company's strategy and where they are in implementing a strategy, and the stage of life cycle as mentioned earlier. And then decomposition, as we've seen in the rate of return section, is pretty valuable where we do a little bit of extra work and we get a lot of value. Here we're answering a question of not only what happened, but why or how did that happen. The area of disaggregation, sometimes we call it DuPont analysis, is extremely valuable as we decompose how did we have the return on common equity that we see, or how do we have the return on assets that we see. An example is if return on equity went up, but not because profitability increased, but because we increased debt. Well, that's not necessarily a good answer then, right? Because we, in a sense, artificially pumped up our return on equity. The area of disaggregation is something you should not skip because it's extremely valuable to answer why and how and not just what. The topic 2 was on shareholder investment returns, where the learning objectives were looking at total rates of return for investors, cash dividends of components return for the investors, and then share buybacks. These particular items are very commonly done by companies and are major discussion points in the boardrooms in major companies. The takeaways from this section are the terminology such as total return, capital gains, dividend yield, capital allocation choices, mergers and acquisitions, dividends, and share buybacks. All of those should sound familiar, and if so, great. If not, you know what to do. And the questions it should be able to answer is, how does an investor measure their rate of return? Or what are the cash dividends and how are they determined, and how do the investors view them? And then why do companies buy back their own shares? Shouldn't they be doing something else with their money? So those are questions you should now know the answers to. A little extra is, let's apply the concepts we just looked at to Clorox. On the left, we see just a snapshot from Yahoo Finance on some of the statistics and current positions for Clorox. Look at that in terms of the terminology we just saw on the prior slide. Total shareholder return, which is the dividend yield and increase in stock price. So how do we look at this for Clorox? Well, the capital gain would be looking at what you paid for the stock and what is the stock worth now. As you can see from the graph, there are ups and downs for Clorox. So if you bought low and sold high, then you'd have high capital gain. But if you unfortunately bought in March of 2020 and then it subsequently dropped, then it's not so good. You have negative return. In other words, you lost money on your purchase of the stock. So capital gain is the risk that you have when you buy common stock. Today, if you were to buy a share of Clorox, it would cost you $137.76 per share. So your purchase has an expectation that, it's going to go up. It used to be quite a bit higher, in excess of, say, $220, and I think it's going to go back. Right? So you're kind of betting on that, right? The next component is dividend yield. The company declares dividend and pays it. If you get a certain amount of cash, you could compare it to what you paid for it, and then that gives you a yield. If you paid $137 for the share, and you expect to get a dividend of about $4.70 next year, that would equate to about 3.28% on the price you paid for Clorox. Again, we have two components. As an investor in Clorox, how much do I get in cash by way of dividend, and how much do I get by way of capital growth or capital appreciation, as we call it, when the stock price goes up. The capital allocation costs are what the Clorox management does to make investment decisions, and M&A is Clorox could do prudent acquisitions to build their new product lines, to fortify their competitive positions, otherwise making their company more successful, more profitable, and have better survival into the future. And Clorox has done many acquisitions over the years. For example, they used to have products that were full of chemicals. So now they still have those, but they've also augmented their product line by moving to green or organic types of products, right? So those were done, some through internal development, but many through acquisitions, like when they bought Burt's Bees, right, as their entry into organic. And the last topic here is share buybacks. So Clorox could buy back its own stock if it had excess cash, therefore reducing the amount of shares outstanding and increasing the value for the remaining shareholders. Topic 3 was the hands-on practice. The first thing was to extract balance sheet and income statement items from the financial statements, and then calculate profitability, liquidity, activity, and solvency ratios, and then perform time series analysis to look at the company's performance and benchmark it against a peer. The terminology was none, because we're just practicing what we just learned. And the skills or practice of skills is, how can we compare against another company? Or how do we compute and use some of the trend analysis that we've been working with? Or how do we compute and interpret liquidity ratios or activity ratios or solvency ratios? And what conclusions can we make at the end of all this analysis on the overall health of the company and the profitability of the company, and how could we present them to others using graphs? So Module 5 was a very important module, one of the core learning aspects of this entire course, because we're using ratios on the financial statements to evaluate the company. Then we also looked at a big topic of shareholder return and shareholder distributions. In the topic 1, we did the analysis using the toolkit that hopefully you are now familiar with and will use in practice, because practice makes perfect, in ratio, trends, common size. And those tools will give you all the insights that we mentioned about profitability, health, and return on investment. And there are liabilities and cautions, but this is always the starting point as we jump into a financial analysis of a company. The second is shareholder investment returns. We covered the main elements of investment returns from the standpoint of the investor: dividend yield and capital appreciation. And we also looked at ways that companies could enhance the returns, such as through M&A, capital decisions, and share repurchases. And the third thing was hands-on. Hopefully that exercise was enjoyable and a good learning exercise, because when you're going to do analysis on, say, the first company that you jump out and do on your own, that practice should pay off. All right, so that's Module 5, and I hope you're ready for Module 6, because that is our last module.